Hello and welcome to today's webinar. My name is Erica with Freestone and I'll be producing today's session. I'd like to run through a few housekeeping items before we kick off the meeting. First, I'd like to go over the audio option for today's meeting. Please be sure your speakers are turned on and the volume is turned up. If you are viewing the presentation on an iPad or mobile device, you may need to scroll down to see the slides. Next up, I'd like to talk about the Q&A for today. To ask a question, feel free to navigate to the Q&A tab at the top of your screen. You will type your question in the box and hit the submit button to register it. We will be taking the time to answer your questions today, so please feel free to ask them at any time. If you are applying this program for credit, you will need to hit the checkpoints that appear throughout the event. To check the status of your checkpoint, navigate to the credit tab at the top of your screen. Please note that in order for checkpoints to appear, you will need to make sure all pop-up blockers are turned off. At the end of the event, return to this tab to submit for credit. If you do not see the option to submit, please refresh your screen. You will be taken through the credit submission process in the viewer. If you experience technical difficulties, please refresh your browser window. Should you need technical assistance at any point throughout the session, please navigate to the Help tab to find tips, tricks, and contact information for our support team. It is now my pleasure to throw the floor over to our speaker, Paula.
Thanks, Erica. Good afternoon, everyone, and thank you for joining NCACPA and Stearns Financial Group for their presentation or our presentation of 2021 investment strategies. We're going to spend the next hour focusing on things you should be thinking about when contemplating investment decisions for yourself and for those you may advise. Now, particularly in recent times, most investors have found themselves scratching their heads at one time or another when contemplating their portfolios during COVID-19 and the post-pandemic recovery. Wondering things like, what will all this deficit spending mean over the short and the long term? Should I invest more aggressively to take advantage of the recovery? Or am I being led by a more emotional fear of missing out as the U.S. stock market continues to grind on with valuations surpassing historical highs? Am I positioned well to withstand inflation increases that threaten to erode my portfolio? Where can I go to find some bond substitutes in a low bond yield environment without putting my portfolio at greater risk than I'm able to endure, both financially and emotionally? I'm Paula McMillan, and with me are Glenn Joyce and Jason Croy. We're with Stearns Financial Group. We're excited to be here today to take on these challenging questions, which we would all agree we get a lot of questions about from our clients. Now, one of them particularly is about the debt landscape, and we're going to take that on first. I believe that we hear a lot from our clients about government spending and the significant debt that is accumulated. Clients want to know how this debt will impact their portfolios. So let's jump right in by hearing from Glenn first. Glenn, how do you respond to questions from clients about how rising budget deficits and multi-trillion-dollar borrowing may impact various investments now and in the future, and how we at Stearns Financial Group are responding to this within client portfolio lineups?
Well, thanks, Paula. That can be a very challenging question. And, before we give our thoughts maybe on our investment take, I think maybe just give a little more context around the growing budget deficits and debt levels that we're experiencing here in the U.S. I think when you think back about our country's financial health, it has been a source of much attention and much debate. And it has taken a bit of a backseat given all the extraordinary circumstances that have gone on due to the pandemic. And I think it's kind of like getting the patient out of the bed and back fully on the patient's feet. The focus has been much more, short term. And our fiscal health as a country is taking a little bit, like I said, a little bit more of a backseat to the health of our citizens and just trying to make sure that we recover in a safe fashion. So there's those short-term and long-term considerations. Sometimes they can be in conflict. So why don't I go to a chart here to kind of help with the discussion, and then we'll get to the investment views. But this chart here is from the Congressional Board Congressional Budget Office. I'll get over here in a second. And that was based in July. And first thing I want to kind of highlight is we do know that it's been just a very extraordinary reaction. And we know that there's been massive stimulus. And both, monetary, on the monetary Federal Reserve side, really going back to the financial crisis of 08-09, that's kind of been a standard playbook, some of the quantitative easing and kind of different innovative features that we've seen. But more recently, we've seen more on the fiscal or government spending side. And this kind of is borne out in this chart. It's a busy chart. I apologize. The top right is the federal budget for 2021, and just the scale of it at close to $7 trillion almost just tells you it's been some extraordinary things going on in the past year or two. And you can kind of see that on the right side from the sources of financing, just the amount that's been borrowed, the deficit spending. So when you think about that and maybe shift over to the right side of the table or the chart, the top right, you can see that kind of annual budget surplus or deficit, and you can kind of see how much it expanded in 2020 and it's still in 2021. And it is, challenging post-World War II levels. And really, if you look down at the federal net debt level, as these deficits annually accrue to the bottom line and our debt expands, you can kind of see the trend there, and it's not pretty as well. And once again, we are challenging post-World War II highs on that front. When you look at both of those, it's relative to the GDP or the economic growth size of our country. And so we'll talk more about the economic fundamentals, and you can kind of see that a little bit here at the bottom left. You can see there the CBO projections going out current and even further out this upcoming decade. And you can see the numbers look okay, both on the growth. The interest rates and inflation are projected to trend upward a little bit, and unemployment may get back close to where we were, but maybe not quite as low as we were pre-pandemic. The numbers aren't exactly exciting, and I think that's a key consideration is where do we end up on the other side of this. We're seeing a big snapback, and I'll go to a couple other charts. One thing before I exit this chart, I just want to highlight, if you go back to the top and look at the total government spending, notice at the bottom there, these big, massive parts of the budget, the things that we tend to think of as being, reoccurring or maybe non-discretionary, however you want to say, or at least things that require a lot of discussion to, cut back on, for example, Medicare, Medicaid, Social Security, and you could even put defense spending in there, and that may be getting more attention post-Afghanistan. So these things are becoming a bigger and bigger piece. Now, maybe they've come down a little bit given the amount of spending since we jumped up so much on the spending front, but they're still approaching 50% or more of the budget. And then if you think about ongoing, if we do think interest rates may be rising down the road, and that's still a little bit of a debate, but I think we would submit that as we get through this, and if the economy does recover, we expect interest rates to rise. You can kind of see that here. There may be a little bit of a lull, but we do think interest rates will be going north, assuming the economy does fully recover. That is an assumption we get through the pandemic. And then you think about kind of where we are with the economy. And the next slide here just shows just the V-shaped recovery we've had on the economic growth front. You can see the trend on the left side of growth going back to late 2016. We were growing about 2.5%. It's kind of that trend growth rate. And then you can see, obviously, things fell off when we had that imposed shutdown to kind of protect ourselves from the spread of the pandemic. And then we've had a sharp recovery, more anticipatory recovery, given the stimulus, given what the Federal Reserve is doing with low interest rates. And so we're now kind of getting back above now where we were pre-pandemic on the growth profile. So the question will be, once again, where do we go from here? And as we think about that, let's look at the components of GDP or economic growth. And the consumer is still very key. You can see consumption or that consumer strength spending is going to be anywhere from upper 60s to close to 70%. And so that's going to be a key that we get unemployment back down. Everybody's working at the best capacity. We do know that housing has been very strong, but that's a smaller part of the budget, less than 5%. So overall, we're going to be watching these numbers very closely to kind of get a better feel on where things shake out post, because the concern would be when you have these booms, we've got all these kind of ramping back up. We've got these supply demand imbalances. Obviously, that's feed into inflation. The concern is, where do we go from here? And is there any kind of potential bust potential on the other side versus more of an orderly kind of trend back to normal growth rates, whether that's 2%, 2.5%, whatever that trend is. Now, as we think through that and we try to look out at what we would do from the portfolio side of things, I think where that leads us to is we are thinking that there's a good chance that we do expect interest rates, inflation, and probably taxes, all those three things, there's a good chance they're going to be higher tomorrow than they were yesterday. We don't know exactly how much higher, and we don't know for how long, but we do think the trend is probably to the north in those areas, and so we want to prepare for that. And so what that probably means is that bonds, for example, are going to be an area that we're going to continue to de-emphasize. And what's been challenging is with low interest rates and just everything we've experienced, it's been incentivizing folks to take on more risk because they can't get the yield from their cash, can't get the yield as much as they had in the past from the bonds. And so they even look for, higher yielding bonds, which correlate a little more with the market, stock market, or they look outside for bond substitutes. So beyond kind of de-emphasizing bonds, we want to make sure we maintain some monitoring of the portfolio stability, but we're looking for other things, whether it's real assets, real estate, somewhere where we can get better yield. We're also looking to go a little more global in our portfolio because we do see some relative value internationally. And so we'll be looking into those areas to try to find opportunities to get better returns, given that we think the valuations are a little more rich in the U.S. But some of that is based on the economic conditions. We would definitely want to acknowledge that. And there could be some pent-up demand as they've been struggling a little more with COVID in certain sections of the world. And so there is a chance that those two things, the relative valuation, some catch-up potential on the economic side compared to the U.S., and that their central banks are doing a lot of the same things the Fed's doing, and they were a little bit more late to the party there, that there could be some nice catch-up there, but we want to understand the risks there as well. And then inside of the U.S. market, kind of looking at growth to value, we know growth did very well during the pandemic. Technology, for example, was able to continue to move forward, even though things were shutting down and people use Amazon and things online a lot more. So we have seen value start to show some prominence really post-election. And we think that especially if inflation or interest rates start rising, that kind of dampens the growth appeal as you look forward out at growth and try to pull it back for a valuation perspective. So value could be something to reassess, more of those cheaper stocks that tend to be not more boring. And then the exposure to real assets, I think, from the inflation hedging potential is also something to think about, as well as just diversification and giving you a different return stream. So that kind of portfolio diversification 101. So I'll kind of pause there, Paula, but unless you kind of move forward. Thanks.
Glenn, I think you did a wonderful job of really setting up, these uncharted waters that we're in today, and how, as you said, everyone's thinking about, inflation going up, taxes going up, interest rates going up, and how that's pushing us farther out on the risk curve, and really setting that up for why it is so much more important today than ever to really be strategic and knowing how you're investing. So thank you for painting that landscape so effectively for us. Jason, how about you? Is there anything else that you would add to how you address these issues when you're speaking with clients and what we're doing about them?
Sure. Yeah. The only thing I would add to this particular section is we got to keep time horizon in mind. As Glenn mentioned, some of the measures that have come with the debt have short-term implications and they have long-term implications. And so the way that we position portfolios may change, as we move through the next few years. The higher debt, the higher liquidity in the market may be good for risk assets in the near term, but they could have longer term implications where we may need to de-emphasize some of the areas that we're emphasizing now. And so just remaining flexible and kind of reading the tea leaves as we go along, and keeping in mind the end goal of what clients are looking to accomplish with their assets in mind, and make sure that we're managing assets in a manner that's going to allow them to meet those goals. That's the ultimate aspiration from our end.
Excellent points, Jason. And you're talking time horizons. So let's transition over to the low bond yield environment that is creating a particular challenge for those who do have the condensed time horizon, who are on the precipice of retirement or retired. Jason, given current inflation and interest rate environment, are bonds still valuable for risk-averse investors, or are you leaning more onto or toward potential bond substitutes?
Sure. Thanks, Paula. It's a great question, and the short answer is yes. I do think that the bonds do play a role in a portfolio, particularly for risk-averse investors. But the way that you invest in bonds, or the way that you think about bonds in the portfolio, is going to come into play. It needs to be front and center of mind. And so, the key question regarding how that relates to inflation is this higher inflation we're experiencing now going to remain high, or is it likely to moderate into a more normal range going forward? And if it's not persistent, then will the bond returns that you can get offset that higher cost of living going forward? And then the other question that I'm help clients think through is, what is the goal of the bonds in the portfolio? Are you using the bonds for actual income, or are you using them more as a preservation and ballast to offset choppy times when in the stock market? And so those are a little bit of two different reasons you may own bonds in a portfolio. This visual I pulled up here, you've probably seen it before. It just shows the dark blue line is the yield on a 10-year Treasury bond, and just illustrates that interest rates have been in a declining trend for several decades now, since the early 80s. Inflation has historically been below what you could get on those Treasury bonds. There's typically been a spread that Treasuries have offered. But that dynamic really went away over the last decade as interest rates dropped into the same level that inflation was increasing. And if you look at the far right of the graph, you can see that inflation has spiked up here recently. This data goes through July of this year, and the most recent reading in July was that year-over-year inflation, or cost increases, were 5.3%. And so the question is, what's causing that? And it's a little bit of supply issues and demand issues. Coming out of 2020, consumers were somewhat flush with cash, whether that was from not being able to spend as much last year, as we were all likely in our homes more than we anticipated, or potentially from receiving stimulus money. Either way, coming into 2020, consumers had more cash on their balance sheets, and there was a little bit of pent-up demand. During the first couple of quarters of this year, as vaccines became more prevalent, people began to get more comfortable moving out in the economy, buying goods and experiences that they couldn't purchase the year before. And so that higher demand has increased in the market. So we've seen demand pressure increased. And you've also probably heard stories about the supply chain issues companies are dealing with at the moment, and maybe even seen some of the pictures of ships sitting in the ports where there's a very big backlog of goods waiting to be unloaded from those container units. That supply issue, it's meaningful and it's complex at the moment, and it's pushed the supply of goods down. And so when you have that higher demand in the market, as well as low supply, that's the recipe for inflation. But going forward, we would anticipate that once consumers spend some of that excess cash that they may have, they're likely not going to spend at a above average rate for an extended period of time. So those demand pressures will likely start to moderate. And capitalism has a way of reallocating resources. So where there's bottlenecks in those supply chains at the moment, it may take another 6 to 12 months, but companies will figure out the best way to get their products to the end user. And so some of those supply issues or distribution flow will turn to a more normal level. So you'll see the demand come down, and then supply will start to come back online as well. So when we look at the future price increases, or the future rate of inflation, should begin to moderate as we get through this fixed period of time. So we would suggest that inflation is likely to settle back down in a 2 to 3% range, perhaps in 2022. And that as that happens, we're also likely to see, as Glenn mentioned, bond yields begin to rise. The economy is growing at a robust rate. Bond investors are likely to are going to start demanding higher interest from their loans to companies and to the government, and that's likely to push interest rates higher. And certainly the Federal Reserve is going to influence the short end of that curve as well. So we're likely to see inflation come back down. Interest rates are going to go back up, likely to go back up. And so overall, you should start to see that gap between inflation and bond yields come together in the future. But it's going to take a while for that to happen. I'm going to show one more chart regarding bond returns. the rising bond yields is typically seen as a recipe for negative returns on bonds, and rising yields or rising interest rates do push the price of bonds down. But what we're suggesting is that investors really think through and match their holding period of bonds with the maturity of the bonds that they're investing in. So what this chart shows, on the bottom, it again has the 10-year Treasury yield. And then from the point that you start invest, whatever that yield is when you first invest in your bond portfolio, what did bonds return over the subsequent 5 years? And so that vertical axis shows the 5-year bond returns from the point of investment. And there's a very tight relationship here. And for the statistical folks on the call, your starting yield in a bond portfolio explains about 88% of the variability in your future bond returns. In other words, the yield that you invest in on your bond portfolio when you initially put your money to work, that's predictive of what you would expect to get from a return perspective. And so the bond prices are going to fluctuate during your holding period, but as long as you hold bonds through their maturity and you avoid defaults, then bonds are going to mature back at their par value. And so a lot of that negative price risk can go away as long as you hold bonds through a maturity. And so a good example would be if you need to invest your cash in a conservative manner for, say, a 5-year window, and you buy a portfolio of bonds that has an average maturity of about 5 years, and for if the yield on that portfolio today is just say 2%, it may actually be a little bit less than that, but for example, say 2%. As long as you hold that portfolio for that 5-year window that you intend to, you would expect to make about 2% on return on your money. Your actual return is going to be dependent on some other factors, whether you're reinvesting your interest payments and are you reinvesting at a higher rate or a lower rate. But by and large, horseshoes and hand grenades, that current yield is what you would expect to get as long as you remain invested through the maturity cycle of those bonds. And so we would submit bond yields are extremely low right now, but they can offer positive returns as long as you're willing to hold the bonds through the maturity cycle. And so for a lot of our clients, keeping those maturities lower so that as bonds mature, perhaps we can reinvest at higher rates of interest if interest rates are rising, would be a strategy that we would likely use, but not necessarily writing bonds off as a lost asset, just given that inflation may be increasing or inflation may be higher than normal at the moment, and that interest rates may be increasing a little down the road. One other dynamic I would mention for bonds in the context of a portfolio is that even if you're not investing in bonds purely for the income component, bonds provide stability. And historically, this particular table looks at the standard deviation or the volatility of bonds versus stocks. And you can visually see bonds over these time frames, bonds have consistently had a much tighter range of their price movement than what stocks have had. Stocks have had a much wider range of price movement. And so for those more conservative investors, having that stability may be worth continuing to own bonds if you can get a small positive return out of it going forward. It may not keep up with inflation over the next couple of years, but down the road, if interest rates do continue to rise and inflation does moderate, like we would expect, that dynamic may work its way out a few years from now. And so the bonds do provide stability, and they do provide, hopefully, some element of positive return throughout a holding period. Then maybe the last point I would make, this is a busy chart. I don't want you to get too caught up in all the dynamics going on here. What you need to know, the vertical axis shows the yield of these different income producing categories. It's called a hedge yield because some of these categories are international, and the data is hedging the currency back into US dollars. And then, so it's the yield on the vertical axis, and along the bottom axis is the correlation of these categories to US stocks. And what you can see, those blue diamonds along the bottom left, those are treasury bonds, and they offer very low correlation to stocks. So they a very good diversification benefit in a portfolio, but they're not giving you much yield. And as Glenn mentioned earlier, investors may be encouraged to reach for yield and go into riskier products. So they may be willing to go into those gray and purple diamonds or categories in order to try to get high yield, but take on other types of risks like default risk and certainly quality risk, particularly if you go to the far right side of those purple and gray diamonds, where you're looking at emerging market bonds or high yield bonds, junk bonds. You may get attractive yields, but you're losing that diversification aspect that bonds would typically bring to a portfolio. Those have higher correlations with the stocks. But the other aspect or element on this page, those green diamonds are private investments that historically, some of these categories have been able to offer low correlation to stocks and attractive yields. And so, as Glenn mentioned earlier, for a lot of cases, it may make sense to start to de-emphasize bonds, so not have as high of a weighting to bonds in a portfolio, and layer in some of these other categories that can offer that same income potential with low correlation. I will comment that each of these investments are going to have their own unique set of risks, and those risks have to be evaluated on a client-by-client basis to make sure it fits a particular situation. But in a lot of cases, we found that it has been additive to the client outcome by layering in some of these alternative assets, whether that's real estate or private credit or other strategies that may not be shown here, whether they're options related, but other income producing areas in addition as a complement to their existing bond portfolio. And so overall, kind of wrap that up there, Paula, but overall, we would expect bonds to maintain a reasonable allocation within a portfolio, but perhaps not the same weighting that we've had in the past. We think we'll get the positive returns. We think that we'll get the ballast, but there are some other areas that would make sense to start layering in if it fits in a client situation.
What a great discussion that really hits the bullseye in terms of what clients are concerned about, our retiring clients. I would refer our listeners to the stearnsfinancial.com website if you're looking for some written discussion on inflation, if you're getting a lot of questions about that from your clients, that you could potentially send a link on to someone that may be helpful. But the way Jason summarized all of that and positioned the inflation and then how bonds relate to it and the role of bonds in the portfolio and the different roles that it can play is very helpful. Glenn, do you have any thoughts or cautions that you want to add on the topic of bonds and bond substitutes?
Well, Paula, it's just a topic that, I discuss this regularly with my dad, and I emphasize with retirees, people that, are looking to live off their portfolio of assets, their growth over many years of working. And it's a very challenging environment if you are wanting to, have some stability in your portfolio. And so if you are trying to decide, what you're going to do with your bonds, there's just a big debate how to attack the bond portfolio. As Jason mentioned, this last chart here was very key, I think. You've got one approach is no matter how much you decide to put into bonds in your portfolio, you've got to make a decision. How much do you want to have to core bonds or higher quality investment grade bonds? And when we talk about bonds, traditionally, we're talking normally about the Barclays Ag, which is predominantly investment grade bonds. And so that gives the best diversification features relative to stocks. But as Jason mentioned, if you're trying to kind of juice the returns a little bit on the bond side and maybe go into some higher yielding debt, then you just got to recognize, like this chart demonstrates, you're starting to have a little more of an alignment with the stock market from a return perspective and a volatility perspective as well. So sometimes we say, let bonds be bonds and let's decide how much we want to have. And so I think that's one key decision is what's the composition look like on the bond portfolio? How much risk do you want to take there? Or are you willing to kind of play defense and let it be a good diversifier for the stocks and other assets that you're going to utilize? And then if you do look outside the bond spectrum, then you may want to pick up yield, and we'll talk more about real estate, other ways to get some income beyond bonds. But I do think you really want to think about that portfolio diversification and just how much risk you're taking, and just make sure you're kind of going in eyes wide open as you kind of try to leave bonds for other things.
Okay, I'm seeing a question come in. What is a convertible bond?
Yes. So, Jason, do you want to take it or do you want me to?
Yeah, I can go ahead. I can grab that. So a convertible is essentially it's a hybrid security where a company issues a bond, and perhaps they can do so at a lower interest rate than that they issued just a traditional fixed income instrument. But the reason they can issue that at a lower interest rate is that the investor has the option to convert that bond into shares of stock. And so the investor or the company may have to issue shares of stock to investors if the stock price of the company goes higher. And so if the stock price goes higher, it will drive up the price of that convertible instrument. If the stock price does not go higher, then it will remain a bond and the company will continue to offer interest payments on that. And it does have a maturity date similar to a bond. So it's a little bit of a hybrid product where you get bond aspects on the downside, but stock aspects on the upside. And so it's going to have a little bit of a correlated behavior with both of those markets.
And for our listeners, we will take some questions as we go along, but most we will tend to save toward the end, unless it's really germane to the topic we're talking about, just to watch our time. So given this low bond yield environment we've been talking about, investors tend to be moving more toward real estate in many cases, especially with those current worries about inflation that we're talking about. Glenn, how do you feel about income producing real estate, and which areas do you find most attractive?
Well, Paula, real estate's something we've been using for quite some time, and more recently, just more broadly, real assets. And so we definitely like the diversification aspects. And so differentiated return streams, they're going to behave a little bit differently from traditional stocks, traditional bonds. We do want to think about their inflation hedging capabilities, one thing. So maybe I'll go to a slide here if I can navigate over. It might hit on that point just a little bit. And that's kind of one aspect. So this is from Versus Capital Research. Some of our clients know we utilize Versus in our portfolios. They have a couple real asset type focused funds. And so this is looking at, and I will say before I go too deep, when you go into real estate, some people think more about traditional REITs that are on a stock exchange, for example. We tend to favor or have been favoring more trying to get exposure to the private markets. And so we like getting kind of off market because we feel like, one, it reduces some of the volatility. Now, some of that is due to less frequent pricing. So we want to be transparent about that. But it does kind of also kind of get away from the whims of investors, kind of that sentiment piece, that kind of ebb and flow of psychology. And so we like to kind of try to get more focused around the fundamentals of the real estate or real asset markets. And so we feel like this gives us a little bit better chance because they are a little more liquid. We got to kind of acknowledge that as well. When you go into the private arena, that is becoming much more, the private asset market is becoming much more accessible in general to investors, but there could be some true, what we call private placements, where you have to have certain income or net worth considerations to qualify. So definitely want to kind of lay all that out. But this is a fund that we utilize in client portfolios, a couple funds, and this is more the indices that they represent to kind of talk about the value proposition around private real estate, infrastructure, farmland, and timberland, which kind of make up the majority of their composition. When you start looking at, they have a real asset fund, which is in these three areas, and then more of a real estate kind of that focuses on all kind of real estate areas of the market, more around all the major segments. So the big takeaway here is that when you think about inflation, like we both discussed, Jason and I did earlier, there is concern that inflation could be a little bit higher than normal. And this looks at periods where inflation is kind of more modest, like we've seen maybe the past few decades or last couple of decades. And so you're looking at maybe below 2%, and that's kind of in yellow. And then you look at areas where it becomes more of a surprise when it's over 2%. And I think the takeaway is that these assets do have some hedging capabilities. It's always, you never know what the future cycle is going to bring, and it may be that this time is different. But we do think we want to kind of think about, when we're trying to get additional income and differentiated return streams, we also want to think about the chance that inflation interest rates do rise materially. And if they do, we would probably want to be in real estate and in stocks as well, for that matter, because a lot of times stocks can pass along some of the costs to the end consumer as well, the companies that are there. And so when we think about these two areas, we want to make sure that not only are we thinking about, where inflation is trending, but is there a chance it may even be much higher than expected? And so I think this does give us a little bit of insulation there. Other aspects that we like about real estate or just when you start thinking about kind of once again, how it fits into the portfolio, we like that, once again, as differentiated return streams. And we think that you can always look to it as a chance to say, how much do you want to have there? And we typically have had somewhere, 10% roughly. And we've kind of gone between that and real assets, maybe 5 and 5, but that's kind of where we are currently. Now, we'll say the real estate market has been very, very hot. And so when you think about how strong it's been, we are looking out, and the inflation and the interest rates are trends that could make the market a little bit less favorable as we go forward. So I think when we look forward, we're obviously monitoring, interest rate trends. We're monitoring kind of how much discount we want to put on those future earnings. And we're trying to think about just how much protection there is if things were to go the other direction.
Good discussion, Glenn. So we're trying to balance, it sounds like, some of the high valuations we're seeing today. We want to buy in at the right time. And then that with all of the benefits that you mentioned, differentiated return streams being somewhat of an inflation hedge, reducing volatility, and getting you away from the whims of the investors that can be embedded in the stock market, somewhat more liquid, diversified. So trying to balance those two. Jason, how about you? Is there anything else you'd like to add to this list of pros and cons with real estate?
Yeah, I would just like to acknowledge there's obviously certain different types of real estate you can invest in. What we're doing with client portfolios is more focused on the commercial side or the real asset side, and really sort of the institutional products to give them high quality holdings from a risk reward standpoint within the portfolio. You can obviously own personal real estate, own personal rental properties, invest in partnerships. You can own public REITs, and they're all going to have kind of different dynamics associated with them. The public REITs, you're owning an equity position in that real estate investment trust. And so while there is a higher income component because of the pass-through nature of those, you're going to have high volatility. And so you get real estate exposure, but it's a little bit different. It's more stock-like exposure, so a little bit different than what we're referring to here. And then certainly with individual rental properties, you have maintenance issues or maintenance risk, that operational risk, where you have to have a little bit more hands-on nature with that. The people on this call could speak a lot more to the potential tax benefits of owning those properties individually than what I could do here. But you may have some other benefits or other considerations that you could do with your money and still have that income component. So I'll just point out, there are different types of real estate. What we're trying to do for clients is give them exposure to very high quality properties, high quality managers, and asset classes that offer that diversification and higher income than what they may be able to get out of traditional investments.
And Paul, I'll just maybe mention one thing. I didn't cover one slide, and Jason, I think, started to summarize or at least make some good points. Let me go to this next slide here that may give a little more insight. And we're going to be talking a little bit later about the 60-40 traditional portfolio, 60 stocks and 40 bonds, and how that could be antiquated as we go forward, given not only the low interest rate environment, but also thinking about stock valuations and just what should we expect as we look forward on return potential for a 60-40 portfolio. This is a little bit busy chart in terms of some of the areas, but it does hit on a lot of these themes we talked about in terms of the private real estate, the timberland, private infrastructure, some of these investments on the prior page, real assets in general. And we start looking at the 60-40 portfolio, 60% stocks, 40% bonds, which is kind of that little yellow circle in the middle. So you can kind of see kind of how things have done. And what we're looking at is standard deviation along the bottom. And we're also looking at annualized returns. And so what we want to do is we want to be kind of on the left side of risk, which is standard deviation. So it's kind of the bottom, we want to be more left, and we want to be up as high as we can on the annual return piece. And so you can just see kind of big picture that I'll point out the traditional assets briefly as well, kind of the triangles, horizontal triangles. The bottom one in kind of navy blue would be more the U.S. bonds, and the one to the far right would be U.S. stocks. And so you can kind of see where you're talking about bonds, kind of low volatility, but low return potential generally. And this is going back, I think, to 1993 through the end of 2020, I believe. And then stocks, just the opposite, getting very, very strong returns, which have even been higher in the last 10 years, I think closer to 15% for the U.S. stock market, or at least the S&P 500, but having to deal with a little more volatility as far to the right as you can see it is. Noticing that these assets tend to give you, and once again, the future may not be, or the future might be the same as the past, but they kind of giving you maybe a little bit more favorable risk reward, or at least some of them have. When you blend them into the portfolio, that's the goal, is to kind of make the portfolio have a little bit better risk-adjusted return potential.
Thanks, Glenn. We started talking more about preservation of the portfolio and kind of the more conservative side in the beginning of this discussion. Now it seems like we're moving more toward not only that, but opportunities even more so. And it seems like more and more opportunities are being opened up to the average investor in different strategies that they are now invited into that maybe they haven't been previously. Jason, where do you see opportunity? Which market segments and types of stocks are still attractive given the current valuations and trends? And maybe what are some new things you're seeing? And how do you differentiate them and their potential value to client portfolios?
Sure. So I'm going to pull up an illustration here. The economy is growing at a very robust pace at the moment. We would anticipate that continuing for the rest of the year and probably into the beginning of 2022. As that happens, what's typical when you come out of a recessionary environment like what we saw last year is some of these value-oriented sectors, what Glenn alluded to earlier, tend to have the best correlation with that economic growth. And so what we're leaning towards or tilting towards in portfolios or wanting to access are those areas of the market where companies are going to benefit from a growing economy. I also want to point out that it's always a fluid situation with stocks. The data, we're going to continue to evaluate the data as it comes in, and we could make changes at any point. But as it stands now, industrial companies, as businesses look to expand their operations, maybe they're replacing some of their machinery, replacing some of their computer systems, building new warehouses. Those industrial companies are going to be direct beneficiaries of that. And so they're going to have a high correlation to strong economic growth. So we tend to like that type of area. If interest rates do trickle higher over the next few years, banks and insurance companies should benefit from that. Some of those public real estate investments may be beneficiaries of that. Energy's had a nice run over the past 12 months. Oil prices are going to be the biggest driver there. And so what oil does, if demand continues to increase in the economy, that could be a driver for higher demand on oil. And so energy historically has had a nice benefit in that regard. And so this list isn't necessarily a ranking of how we would invest client dollars, but it just shows that, those areas that are in gray tend to be traditionally more value segments. These are the areas that have not had the best performance over the last decade, but going forward, at least in the near term, we think they have a good opportunity. Those growth areas in green, they drove market performance over the last decade, particularly the information technology and consumer services sectors. But if we do get in a period where interest rates are rising, those future cash flows in businesses in those sectors are going to be discounted at a higher rate. And that could be a headwind to future growth relative to those value opportunities. And so we're leaning more towards those value sectors. We also think that smaller companies offer a good entry point in a period where economic growth is very strong. So within the U.S. market, the value and small cap, small company exposure is where we're tilting. This is really just kind of an anecdotal visual, something BCA research put together a couple of months ago. We just like it from a visual standpoint. We have been in what they labeled a Goldilocks environment where economic growth has been strong. The Federal Reserve has been very accommodative. We really just wanted to show this to acknowledge there are tail risks out there on both sides. If the Federal Reserve moves faster than anticipated, that could cause choppiness in stocks and could change our thesis. Also, if COVID, we're certainly not behind, or we certainly don't have COVID behind us, and we seem to be regressing in our fight against COVID at the moment. If COVID has a resurgence and has a bigger economic impact in the back half of this year, that could also change our thesis. And so there are tail risks out there that we need to acknowledge, and just know that any type of investment strategy has to be fluid and go with the incoming data. But we do think that those themes of value in small companies are likely to be a good opportunity, at least in the near term. The other area of opportunity I would mention is outside of the United States. And so this is a little bit of a busy chart. Don't get caught up in the detail. Just know on the line graph on the left shows the valuation of international markets relative to U.S. markets. And you can see that as of the end of last month, the end of July, the relative valuation in international stocks was greater than 2 standard deviations below that of U.S. stocks. And that's pretty significant. We should acknowledge that some economies outside the U.S. were struggling before the COVID-19 pandemic. And so there are some reasons that valuations have been cheaper internationally than they have been in the U.S. But when we're looking forward and saying, that mantra of buy low, sell high, we're looking for areas to put money that seem to be better bargains. And right now, when we look forward, it seems to be a little bit reasonable bet that international markets have a better opportunity going forward, potentially just due to their valuations. And so what we're recommending with clients that maybe don't have a lot of international exposure is just, trimming back some of the winners on the U.S. side and tilting into the international side a little bit, little by little. The line chart on the right shows the income component. International companies tend to pay a bigger percentage of their profits in dividends to investors. And so you do get a little bit higher income component internationally than you do in the U.S. And so in a low yield environment, that could also be a meaningful source of income. One more point on the international stocks. Some of you may have seen these charts before, but it just shows that the dynamic of our international stocks outperforming U.S. or our U.S. stocks outperforming international historically has gone in cycles. Most recently, that mountain on the right, the gray mountain, shows that U.S. markets have strongly outperformed international markets really since the great financial crisis over the better part of a decade or more than a decade. When we get 5 years from now and look back, are we going to say that the COVID crisis, the vaccine uptake, some of the amount of budget deficits, the amount of debt that we're taking on in the U.S., are those going to be catalysts to say that the next phase of this cycle shifts where international stocks outperform? There's no way to know that going into it, but given current valuations, we're certainly starting to tiptoe into the international markets a little heavier than we had in the past, just knowing that at some point this cycle is likely to roll over, and forward-looking valuations over a longer period of time, the price you pay when you buy in matters with your overall outcome.
Thank you, Jason. I think you not only showed us where some great opportunities are, but also the value of diversification and not being able to time the market. You spoke about 5-year, time periods or horizons, and the fact that, we can't predict exactly when things will turn over, as you say, but certainly where we like to strategically put a little more weight. But again, just a reminder of how important diversification is. So, Glenn,
real quick, I would just reiterate, this doesn't imply that one international or U.S. is having negative returns over these time frames. It just applies that one is having higher positive returns than the other one. So they could both be going positive, just one is outperforming the other.
Good nuance. Thank you. Glenn, anything else to add?
I think Jason's comments about international stocks resonate with me. I think it's been tough to leave the U.S. stock party because it's been the place to be. And a lot of people think the stocks may be the only game in town right now, given the strong performance. But I think when you look at the S&P 500, it's averaged probably about 15% roughly per year over the last decade. And international markets, more broader ones like, just broad across the scope, international markets have probably been more 9 to 10% less than that per year on average. So, it's been a big gap like he showed on this gray piece. So I think we don't know when the party is going to end or when the transition is going to take place, but I think it's at least smart to kind of keep your eye on the international opportunities over the next decade, I would think.
Thank you. And we mentioned earlier that more products, more offerings are opened up to investors of across the spectrum. And some of those areas we're seeing that are in private investments like private equity, private credit, and venture capital, and how they've really been able to enhance traditional stock and bond portfolios, given especially the current environment that we're in. Glenn, how are these growing asset classes being accessed and providing benefits to that broader range of investors?
Yeah, Paul, I think they're kind of feeling a need and they're becoming much more accessible. And I think some of it is, and I'll go to this next slide here, around the 60-40, once again, traditional stock bond portfolio. And once again, just the maybe less enthused prospects as we look out the front windshield. And this looks more at the yield or the income component. Obviously, there's a growth component as well. But given low bond yields and even low dividend yields on stocks, or relatively low dividend yields, we've seen that drift lower. So you're getting less income, and then you got to figure out, can you make up for it with other areas of providing income, whether it's alternatives, real estate, et cetera, or dividend paying stocks, for example, as well? Or do you try to pick it up on the growth side, where you try to find things that have better growth prospects? And we know stocks are at least elevated based on historical measures. And so in terms of valuations, so that makes your starting point does tend to matter when you look out at where valuations are when you're looking at like future returns over, say, the coming decade, for example. So both of those kind of make it where the 60-40 is just maybe a little less promising, or at least have more modest expectations as we go forward. And then on the accessibility front, this next chart just shows whether you're looking at stocks on the top row, bonds, fixed income on the middle row, or real assets. You look at your public markets on the left, and you're getting a lot more choices on the right for substitutes or complements of things that are kind of what we call in the other asset bucket. Now, we talked a lot about private real estate, private credit, private equity, and then there's other options as well. But I think here you can kind of see the list is growing, and it's becoming much more available slowly to mainstream investors through more liquid products. The challenge is some of these do need to be a little more illiquid, and so some of them are more of a blend or interval type fund, and also some are more like the private placements for kind of the higher net worth folks. So just once again, it's definitely become more accessible. And then as you go to the next chart, a key theme that we're going to highlight is once again the value it can add to the portfolio from a diversification standpoint. This chart just shows volatility. On the left chart shows the S&P 500 and the number of 3% daily moves, 3% plus moves up. So kind of the volatility is higher on these 3% plus days by decade. And you kind of see that we have seen more volatility in recent decades, a lot more days where you're seeing big movements in the stock market. So that's a concern. And then you look across on the right, and you can kind of see these other major asset classes are tending to correlate a little more. You're looking at, previous times and then more recently, and you're seeing kind of in that darker green, kind of since 2008 through 2021 second quarter, you're seeing correlations start to increase with stocks, which means you're not getting as much of a diversification benefit by these other asset classes. So that kind of poses, is their next frontier just additional alternatives to look at to try to improve that correlation, make the correlation less, where you get more diversification benefit. And I think that is borne out on this last chart here, one of these last two here. So this next chart talks about, once again, you're looking at the risk reward framework. How much risk are you taking kind of per unit of return? The return is on the vertical axis, annualized return, and standard deviation of risk is on the horizontal axis. We're looking at 2006 through 2021. And if we start with traditional asset class like investment grade bonds in the bottom left, you can kind of see much more lower on, once again, the risk and return spectrum. Maybe you get more juice or more return, but with more risk on high yield bonds, kind of following that kind of efficient line, that trend line. And then farther out, you see large cap equities on the far right, or at least next to commodities up top. That's also more risk, but more reward. So you got to kind of decide, where you want to be positioned. But as you introduce some of these alternative kind of various other asset classes, whether it's private equity, private real estate, over this time period, they have been able to add some value on when you kind of blend them into the portfolio. And commodities is one area that's been a little bit of a dog, let's say, since 2011. And that's the super cycle buildup we saw in China, the decade prior. And then we had kind of a little bit of a bust period, but those are starting to come back a little bit now with the inflation considerations. And where you kind of blend all this together is you start looking at a portfolio and you say, okay, is there a way to improve either the risk side or the return side of the equation? And you look at your yield, and what you try to do is on the left side, it's more traditional portfolio. And then you look on the right at more one comprised of some of these additional asset classes like private credit and private real estate. And you're hoping to once again improve either the return or the volatility component. In this case, we're getting a little bit better yield as well, 3.5 versus 1.5 in this example. And we are getting close to the same return, a little bit less, 7.7 versus 8. But we are picking up considerable suppression of volatility, 5.8 versus 9.9. So I think mission accomplished, at least in this example. Once again, you could put together a different mix of asset classes and maybe not come up with this nice outcome, but that's the goal. How can we improve the risk-adjusted performance of the portfolio and add value to the experience as we try to meet our longer-term goals and objectives?
Great. Thank you, Glenn. I'd like to kind of wrap up just by asking you both for your final words of wisdom. Just looking out at the environment that we're seeing today and kind of in looking forward, what are some things that you would leave everyone with? What are your main takeaways from your perspective?
You want to go first, Jason? You want me to?
I can start. Again, just appreciate all of you joining today. Thanks for the time here. My kind of parting thoughts would be, when we speak with clients, we have to think about, what are their personal goals, their personal objectives with their finances, and we try to design portfolios that will help them accomplish their financial goals in life. And so, certainly, traditional investments, stocks and bonds, play into that. But increasingly, given the current environment, as Glenn was just describing, we're finding more opportunities in the private side, and so. Really just having conversations with clients and for each of us as an individual investor, thinking about what asset class is going to help us accomplish the goals that we have and developing that strategy and sticking with it tends to be the best recommendation rather than reaching for risk that you're not comfortable with or reaching for into asset classes you're not comfortable with. Just making sure that you're getting your goals accomplished is the primary objective of any of us from an investment standpoint. And so designing portfolios to do that is kind of the first point of conversation we like to have with clients.
Yeah, and I would just add, there's been a lot of product innovation over the years. You think back to mutual funds, then exchange-traded funds, and now these alternative assets. And you just think about there's much more ability to kind of target niche areas of the market. And so with that, I think comes either the onus is on the investor or their advisor to really know what you're gaining exposure to and know the attributes from a risk and reward perspective. Understand the concentration, understand what's trying to be achieved, the amount of leverage in terms of maybe financing or borrowing that may be juicing the returns and or could be a risk if things go the other direction. So you really want to understand the role that some of these new products are kind of playing in the portfolio. So kind of along Jason's lines, I really want to understand the strategy I'm trying to achieve, what's going to kind of get me to my longer term goals and objectives. And then as we start pulling in these different pieces to try to improve the results, really trying to understand how they fit in and try and make a strong case of why they're justified to add to the portfolio.
Great. And I think you guys have done a great job of showing us why it's more important than ever to be active in terms of the way you look at your portfolio and all the options that are available out there, all the challenges. And you've laid out a nice map for us of things to think about and potential ways of solving for them. So thank you to everyone who joined us today. We really appreciate NCACPA and Stearns Financial Group appreciates you joining us for 2021 investment strategies. Please feel free to reach out to us for any additional questions. Thank you.
Yeah.
Thanks.
I think that is all the time we have for today. Thank you, our speakers, for sharing their expertise, and thanks also to our participants for joining. This concludes today's presentation. To submit for credit, please click on the Credit Submission tab. Once finished, you may simply exit out of the browser window. We hope you have a great afternoon.